Hi ladies and gentlemen, welcome back. Today we're going to look the accounting equation under the financial statement, which is a financial position. It is called in other term, it is a balance sheet. Okay, before we can see or we can define anything further about this financial statement of the business, I want to remind you about accounting equation format. It says assets equals to owner's equity plus liabilities. Okay, this is an accounting equation: assets equals to owner's equity plus liabilities. Okay, when we speak of assets, assets are all are all resources controlled by the business. Okay, assets are all resources controlled by the business. Okay, we have a non-current assets, as well as a current assets. Therefore, we have types of assets which are non-current and also types of assets which are current. All right. About the non-current assets, it is where we look those assets which have a long life inside of the business. Okay. For non-current assets, are items which have a long life that bought with no intention to resell them by the company. So we buy non-current assets in order to be used inside of the business for us. Okay, such as a land and building. A land and building is used in order to operate the business. Okay, we have a land and building. Okay, number two, we have vehicles such as transport, where we are transporting goods and services from one place to another. Number three, we have equipment. Yeah, we have equipment such as computers. Now, right. The last one is a fixed deposit. Okay, the last one is the fixed deposit. All these types of assets are assets which belongs to the non-current assets, which have a long life inside of the business. The business buy these assets with no intention to resell them, but for the purpose, for the commercial purpose of the business, in order to gain income. Use transport to transport goods and services, use land and buildings to operate our business, use equipment to record transactions, use a fixed deposit as a money deposited in the bank account for a future use. All right. And then when it comes to a current assets, now current assets are the assets that can be converted into cash within 1 year. Now these assets, they have a short period of time inside of the business. They exist in 1 year. In 1 year, a business can make money by the use of current assets. We have a trading stock, we have a bank, we have debtors. Right. A trading stock are the goods bought by the business in order to resell them to their customers. And then a bank um, is opened in order to invest or in order to deposit money that have been received by the business. And then debtors are people who buy goods or services inside of the business on credit. So we call them debtors. All right. And then now let's go to this a very 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 important part of of assets. Now we want to see the effect of assets on accounting equation. We have a debit side. You have a debit side, and also you have a credit side. Okay, all assets are increasing on a debit side. All assets are as well decreasing on a credit side. So when we are talking about assets, they increase on a debit side and they decrease on a credit side. Okay, so when can you see that this type of asset have been decreased? For example, if a business decided to sell one of their vehicles, so that will make a great decrease toward vehicles. Ne? If the business, for example, having 5 cars, they decided to sell 2 of them, so the left will be 3 vehicles. So these vehicles, this type of asset decreased from 5 to 3. So therefore, on which side it's gonna decrease? They're gonna decrease on a credit side. But if the business received or bought one of, okay, bought a vehicle, okay, 5 vehicle plus 1 equals to 6. So there is an increase. On which side? They will increase on a debit side. All right. So when we see the increasing and the decreasing of the assets, the increasing of the assets will be on a debit side, and also the decreasing will be on a credit side. All right. Now let's move on by defining now owner's equities. Owner's equities. All right. Now define owner's equities. All right. Owner's equities. Okay, owner's equity is the interest of the owner. Owner's equity is the interest of the owner. Therefore, owner's equity, it is where the owner is invested something inside of the business. In fact, the owner is do something which is called the contribution into the business. And then the contribution is also known as what? A capital contribution. Okay, a business owner can contribute with cash and also can contribute with non-cash. Yes, can take cash and invest inside of the business, and also can take any assets. If it says non-cash, it can be a vehicle, it can be equipment, it can be a land and building. Okay, so the owner can contribute with cash. They also can contribute with a non-cash. It can be a vehicle, it can be equipment, and also it can be what? A land and building. Okay. All right. Moving on. Now we wanna see types of owner's equity. We have types of owner's equity which decreases owner's equity, and also types of owner's equity which increases owner's equity. All right. Now let's firstly look those owner's equity, types of owner's equity which decreases owner's equity. We have drawings. What are the drawings? Drawings occurs when a business owner takes something from the business. He or she can take cash, he or she can take stock or anything from the business. So we regard them as owner's equity. A business owner is committing owner's equity. For example, if you are the owner of the certain business, maybe it's a salon, okay, then you have decided to take 20,000 to pay the school fee of your kid from the bank account of the business. So we're going to take that 20,000 as the drawing. You have committed the drawing. It will be an expense. It will decrease our owner's equity. In fact, it will decrease the profit. The more the profit decreases, will be the more owner's equity decreases. Okay, the next one are the expenses. Okay, expenses such as water and electricity, expenses such as telephone expense, expenses such as salaries and wages, and more and more. Anything that we need to pay for, it will be regarded as an expense inside of the business. Ne? All right. So also expenses are decreasing our profit, and they will decrease our owner's equity as well. So these are the things which decreases owner's equity: drawings and also expenses. Then coming to the types of owner's equity which increases owner's equity, we have a capital and also incomes. Okay, a capital, I've said to you, is the money that invested by the owner inside of the business. Anything, it can be an asset, it can be a cash, it can be a vehicle, it can be an equipment or a land and building. Anything that have been invested by the owner inside of the business, it will be regarded as what? As a capital. All right. And then income, we see the sales, current income, about commission income, and more. So incomes, guys, represents a monetary value received by the business in a particular period of time. So anything that making a business to receive money in a particular period of time are those incomes. All right, those are the incomes. Okay, now on which side does owner's equity decrease? On a debit side. On which side does owner's equity increase? On a credit side. Okay, so all things which decreases owner's equity, they belong on a debit side. They have their balances on a debit side. And then all things that increases owner's equity, they have their balances on a credit side. All right. I think we have an understanding about owner's equities now. Okay, let's move on to the liability, the last thing we need to do. Okay, okay, now the last one, it is about liabilities. Okay, liabilities are all debts of the business. Okay, business can make a debts, so that particular debts are called, we call them liabilities. Yeah? So we have a non-current liabilities, and also a current liabilities. Okay, non-current liabilities as well as a current liabilities. Now, non-current liabilities, we have a long-term loan, as well as a mortgage bond. these are non-current types of non-current what liabilities. Okay, non-current liabilities are those liabilities which can be paid, uh, okay, can be paid in a period of more than 1 year. It can take 5 years to be paid. It can take 6 years, can take 10 years to be paid. But when it comes to the current assets, are the debts which can be payable within 1 year. They can be payable within 1 year. For example, we have a creditors. Creditors are people who provide a business with goods or services on credit. Ne? So those are creditors. So a business can buy something on credit. People who provide us with anything on credit, we are calling them creditors. Right. Now moving on, we have a short-term loan. A short-term loan also is when a business is taking a loan of maybe of 12 months or of 6 months. So is debts that can be payable within 1 year. Okay, the last one, it can be a bank overdraft. Okay, bank overdraft is occurring when the business is over withdrawing money from the bank account of the business. So when we want to buy something but we don't have enough money to buy that particular item, so we will automatically commit lento esiyibiza ngokuthiwa yini, it's a bank overdraft. Alright, so okay, now we are looking for the effect of all what's liabilities. Okay, we have a credit side and also a debit side. Liabilities are increases on a credit side but decreases on a debit side. So all liabilities increases on a credit side but decreases on a debit side. So you need to understand that.